Hi everybody, hopefully you can see my screen. Just have a look. Yes, I can see it on, and that's great. Hopefully you can hear me okay as well. I've got the pound up as well, as you can see, and I'm on the pound yen. And we're just starting to see this reaction, this technical reaction reversal for lots and lots of different reasons, not least because we're starting to see volume come into the market. We're starting to see, we've obviously got the crossover into London session, which is a classic time for reversals, traps, volatility. You're going to see this across every single currency and currency pair. It's what you expect to see. It happens relentlessly every single day, and you just have to be aware of it. Now, what's interesting right now, this is the 5-minute CSI I've got on the left-hand side here. And in terms of time frame, I've got this very quick one, the 15-second, which I love to have up for intraday, obviously. I've got the 1 minute, the 3 minute, the 5 minute, the 10 minute, and over on the right-hand side here, I've got the daily chart. Just pull that down a little bit. There we go. What's actually happening at the moment is whilst there is this reaction, this reversal, what's interesting at the moment is that it is largely being driven by the yen sentiment, and the pound is just starting to pick up, and that's the reason why throughout this initial phase, if you like, this initial phase of price action, this initial potential reversal, the strength of that trend was not particularly strong, and it wasn't particularly strong for that reason alone, purely because the move itself was only being driven on one side of the currency by the strength of selling in the Japanese yen. And that's the reason that this was kind of moving sideways. Yes, it had some minor bullish sentiment to it, but it wasn't particularly strong, and it's only starting to pick up strength. You can see it here now on the 15-second chart. You can see the trend monitor here has transitioned through very quickly. We've gone from bearish into a darker color, darker blue, and out the other side, no dark red on that occasion. Exactly the same thing here. We've gone straight through, we're into bullish, we're in blue. You're starting to see it transition over here. Here we've got classic bright red, dark blue, and out the other side into bright blue. No change yet on the 5 minute. You wouldn't expect it, nor indeed down on, let's just move that up a bit as well. It's very untidy. I like to have my charts nice and neat and tidy. There we go, pull that all up. There we are. No change on the 10 minute. You wouldn't expect to see it. And it's just a facet of multiple time frames. Now we're starting to see this pick up quite dramatically. Why? Because we are seeing strong buying in the pound, and we're seeing that counterweighted, if you like, by strong selling in the Japanese yen. And that's what you're looking for the whole time. And it's a really nice example of what to look for in terms of the strongest trend. Yes, you will get a trend when one of the currencies, as was the case with the Japanese yen, was falling, but the other currency was flatlining, didn't really have any momentum in it. But as soon as you start to see momentum in both, then you're going to see a strong trend. And right now, I don't even need to look at a chart. I can tell you off the bat that, you know, the Aussie yen will be moving nicely. Why? Because you've got very strong buying of the Aussie, strong selling of the yen. Same on euro, same on New Zealand. You know, you're spoiled for choice. And equally with the dollar now selling off quite strongly as well, the red line, you could pick any of those and there would be a strong trend on the intraday charts for sure, without even looking at a chart. And that really highlights the whole process, if you will, of the CSI and why we developed it. It is your window on the world. It's the starting point. I've used so many analogies over the years. It is really like it's like a trawler setting out to sea. What do they have? They have a sonar. Why do they have a sonar? Because they want to go and fish where the fish are. They don't want to fish where there are no fish. So they go and look for those areas where you've got big shoals of fish. It's exactly the same principle with the CSI. But not only does it reveal where to go and look for trades, it'll tell you which trades which are perhaps not so strong, as I've explained, in terms of whether the currencies themselves are moving higher or lower strongly. If the currency itself is moving in a horizontal direction, for example, the Swiss franc here is flip-flopping around at the moment, not terribly strong one way or the other. So any of the Swiss pairs at the moment, yes, there may be a trend develop shortly, but at the moment they'll be moving sideways because they're only being driven on one side of the equation, whichever currency you care to take. And the same is true of also the Canadian dollar. If you were looking at trading the commodity currencies right now, the two you'd be looking at would be the Aussie and the New Zealand. You wouldn't particularly be looking at the Canadian right now because it's flip-flopping around in the oversold. It's tried to rally, it's turned down again. It's not really going anywhere. So that's always the starting point. And just in the same way that you have multiple timeframes on the charts, we have multiple timeframes on the currency strength indicators as well. Just drop that out the way. I've got these on 1 minute, on 5 minute, on 10 minute, and on 15 minute. And again, it's another aspect, if you will, of using multiple timeframes, because what you're looking for constantly is you're looking for the start of any trend reversal or a move in an opposite direction will always start with your fastest time frame. So down on the 1 minute, that is where you expect to see it. We're starting to see pound buying. It's having these pause points on the way up. What have we got on 5 minute? We've looked at that chart. It was heavily oversold. Now it's starting to rally. Over on the 10 minute, you've got the same sort of thing. And exactly the same over on 15, starting to rally. And it's really the Japanese yen that is selling off so strongly, that is driving the market right now. And if a move is going to become a true full-blown reversal, then it will move from your fastest time frame, whatever that may be. It will then appear in this next slowest time frame. It'll appear in your slower time frame, and so on down the chain. And that's the principle, if you like, of a reversal, and whether that reversal has momentum to carry through your particular time frame of opportunity. In other words, the window of time that you're looking at, because rest assured, you may be long this particular market, you may be jumping in and buying pound dollar, pound yen, whatever it may be, but somebody else on a much slower time frame, what they will be seeing, they will simply be seeing this as a minor pullback, a minor reversal against a longer term trend. And that's a fact of trading that you have to get your head around. You have to accept it. And it's the reason you have to have this blinkered approach to what it is you're trying to do at that particular point. If you're trying to scalp this market over the next few minutes, that's fine. If you're a longer term trend trader over much slower time frames, that's fine. You're simply looking at this. You have perhaps curiosity towards it, but nothing else, because to you it's not important. To the scalping trader, it's important, it's an opportunity, but to you as a longer term swing or trend trader, it's not important. The markets moving in one direction, then they reverse, minor pause, minor pullback, then they continue, etc., etc., and it's constantly repeating. And that is what you're seeing the whole time. All the time you're seeing this wheels within wheels, if you like. It's that constant rotation of time where the trades are moving against you, coming back with you, moving against you, and so on and so forth. Let's just head back to the chart, see how we're getting on. This is what we're seeing right now, the continuation. We had a little bit of a pause point on 15-second, but look at it on the minute. The trend monitor. The trend monitor was developed with it really only has one objective, and it was developed to help to give you the confidence to stay in a particular trading opportunity, because the one thing that kills most traders is not a lack of understanding of how the markets work. It's not a lack of understanding about technical analysis or fundamentals. It's the ability to stay in a trade once it's underway and maximize whatever you can, because the market is designed in these little pullbacks that you see here. The market is designed to kick you out, to frighten you out, to stop you making money. And that's why we developed the trend monitor. There's no flicker of a change here. We've just gone straight through. We had a minor pullback here, but if you look at the volume profile associated with it, what have you got? You've got falling volume. And it's a key facet of what Anna referred to in terms of technical reversals. Is this reversal a true reversal? In other words, are we now reversing from this, which we consider to be a primary trend, into congestion, and now we're coming out the other side into a primary trend higher? In other words, we've gone from primary trend lower into congestion, out the other side into primary trend higher. So this is now shaping up into a full-blown reversal. When you're trading in a trend, you will see secondary trends develop all the time, and that's what they are. In other words, we've got a little example here. We had the bearish trend lower. The market's tried to rally here. What have we got? We've got falling volume. What is that telling us? It's telling us this is almost certainly a secondary trend against the primary. In other words, it's not a full-blown reversal. It's just simply one of those many reversals we see, the pullbacks, which are highlighted on the CSI. And that's the key to all this. That's why we developed the trend monitor, used in multiple time frames to give you the confidence to stay in. What we're seeing right now in 1 minute, we've got this candle here, we've got a wick to the upper body, got some decent volume under. And remember also, when we're comparing volume, this is 8 o'clock London time. So when we're comparing volume, we are comparing across this slice of time, because up until that point, from where are we, 7 o'clock here, this is Europe, so we can certainly, when Europe was trading, if we were trading in the European session, we can certainly compare that. Then we move into London, and we expect to pick up in volume, which is what we are seeing right now. So we've got a little bit of weakness coming there. Doesn't mean it's going to reverse automatically, but certainly a little bit of weakness. Now we're starting to push higher. Then we start to focus on other aspects of the indicators, like the volume point of control. What have we got ahead? Well, it's nice to see we've got volume falling away. What is that going to tell us? Well, it's going to tell us that the effort down here to push the price action through this region is going to be much less than the effort it's taken to get through this lot here. So we've got a huge concentration of volume here. We've obviously got the maximum here is over on the volume point of control, which is where the volume point of control sits, always at the highest volume on the histogram. But then as we move into these lower regions, we've got a reduction in volume here. We've got a much lower volume here, a low volume node here. So as the price action approaches these regions, we've got volume falling away. For the price action to push through here, it's going to take a lot less effort in terms of volume down here than it would do to drive through a much higher region of volume, which is down here. So from a trading perspective, it's good. And what you'll see on the chart as we move up through the various levels is, as we get to low volume nodes, let's see what we've got on 3 minute. Okay, and this is another facet of using multiple time frames. Now, what's the 3 minute chart telling us? Well, it's telling us loud and clear that we've got some fairly stiff resistance ahead. First of all, we've got some decent volume here. So that's already been tested and sort of brought it to a halt. But there's another reason it's coming to a halt, is because we have these two levels here. These are price-based support and resistance levels using the accumulation distribution indicator. If you're on MT45, then we have the dynamic support and resistance indicator. Basically, they work on price. And the indicator describes graphically the strength of those regions, because what it does all the time, once an area is tested and holds, then the thickness of the line will thicken. And you'll also get a little number alongside here. It's underneath the VPOC at the moment, but you'll get a little number to tell you how many times that's been tested. But in essence, what it shows you instantly and pinpoint accurate, I have to say, these lines are not great thick areas of vague support and resistance. These are absolute pinpoint accurate. They're a bit like the Camarilla level. They're very accurate, very precise. You have to allow a little bit of leeway with them, of course you do. But in terms of what they present to you, is they present the areas of resistance and support which are like to come into play. And we have two of them here. So not only are these strong in their own right because they're quite thick, but we have a cluster of two. So in terms of now taking this trading opportunity, this is not a good sign, because this is almost certainly going to, at the very least, cause the market to congest, come to a pause point. It may well push through there, but in pushing through there, you've got to see a lot of volume drive through there. And then the next phase up, you've got more volume up here, almost as much as the VPOC down here. So we've got a ton of volume up here, which has been built because this is where the market was sitting for a long time. So in terms of jumping into the market, it's not a great opportunity, because for several reasons, the market is likely to congest. And it's just another reason to use multiple time frames to give you the information which is going to help you. If we go step down onto the 5 minute, we've got to just move the chat box out of the way. There we go. Similar sort of thing here. We've got the volume point of control on 5 minutes. So again, is this are we going to expect this trend that we're in? Is this going to run for a long time? The chances are no. You know, we're currently trading at where are we, 11 or 12? We've got 25, so we've got 11 or 12 pips before we get up to this level. But for sure, at this level, we are going to see some more congestion develop if it actually gets there. So it's just another reason for using multiple timeframes. Down onto 10 minutes, same sort of thing. We've got the VPOC ahead. We've got very heavy resistance, this red line overhead here. You can see it here better. We've got the blue one here. So there's a ton and a half of reasons in here why we can expect to see this market, you know, not drive through here. What we're also starting to see, you can see it here, the volume that came in is starting to diminish. And if we're starting to see a market that's trying to rally on a falling volume, and we're starting to see maybe this candle closes with a wick to the upper body, you know, this is not a particularly strong signal of a market that's going to develop into a full-blown reversal. You know, it's gone some way. Yes, there was an opportunity to make money in there if you were a quick scalper. And of course, as many as you know, I will always look at the extremes. That's where my eye is always drawn, top and bottom the whole time. I'm looking for overbought, oversold, get into the trade early. I can get out. You know, if you're looking to jump in now, where are we getting to? We're starting to see a cross. We've got a cross on just coming in here. You know, these others will be crossing soon. Is this going to carry on? Just see what's going on. You know, this was the weakness. I highlighted it, you know, when I was talking. This was the weakness that came on, and it's a facet of volume price analysis that you have to accept that things don't happen instantly. You'll see a signal, you'll see a very strong signal of buying, you'll see a strong signal of selling. You think, oh, great, jump in. You do have to be a little bit patient and wait. Just those signals come in, but it doesn't automatically mean the market is just going to reverse and you know, just happen immediately. You have to wait and be patient, but that was certainly a sign of weakness. The next candle also was a sign of weakness. We had falling volume. So the volume's fallen away. So just through a simple comparison of this candle with this candle, we've got much higher volume under this candle. We had weakness coming in with a wick to the upper body. Then the market tries to rally again, but it's on lower volume. And given the spread of this candle is wider and we've got a further wick to the upper body, you know, at the very least, you're expecting some weakness to develop. And really, that's what VPA is about. It gives you the confidence to anticipate what is likely to happen next. Now, at the moment, the trend monitor hasn't transitioned. You may well be considering holding this as a long trade, because what you're seeing now is we saw this little reversal here, rising volume on the first two. Then on the third one, we actually get a little bit of buying coming in under here. So we're expecting the market to rally, which is what we see, but it doesn't look like a terribly strong rally because we've got low volume coming in here. So all this is shaping up to giving us a heads up that yes, there is a rally going on, but it's not particularly strong. And obviously what we're constantly looking at is the longer term trend that has been in place for, and this is the daily, very similar in fact to the daily chart for cable, where we had this big shooting star candle, same sort of thing on cable, further weakness, and then down we go. And yesterday we had this really nice trading opportunity, nice volume under there. And from a longer term perspective, what we're looking at here in exactly the same way as we were looking at on the very fast time frames, we're actually coming into a low volume node here on the histogram. So the market should move through there fairly easily. In other words, it's not going to take a lot of effort to get through there. But if we then look down below, we've got this huge amount of volume. So from a longer term perspective, you know, for the market to crash through here, that is going to take some serious effort because we have this heap of volume here, which is almost the same as up at the volume point of control. And the other aspect of the volume point of control, it sits here at the moment, but it's not anchored in time. It's not forever anchored at just below 139. When the volume builds in another area on the chart, then this will move accordingly. And obviously on the fast time frames, you see this all the time. On a 1 minute, you see it moving from one level to the next. As the market pauses, goes into congestion, starts building, waits there for a long time, the volume's building, and the volume point of control moves down accordingly. And then as soon as we move away from that region, then you're looking for an increase in volume, you're looking for bearish or bullish sentiment to develop, because at the volume point of control, it is the fulcrum of the market. It's the point at which it's in balance. There is no strong sentiment one side or the other. So it's like a seesaw. The analogy I always use is a seesaw, two equally weighted people sitting on either side of the seesaw, doesn't go anywhere. As soon as one of those gets off, one of those people gets off and a heavier or lighter person gets on, then the fulcrum changes, the market moves, the seesaw swings. The seesaw moves one way or the other, up or down, and off we go into the next phase of price action. You can see here on 5 minute, the pound is very lackluster now. It's rallied, but it seems to be coming to an end, which is really what we're seeing on the charts. If we go on to the currency array, let's go and have a quick look at the currency array. There we go. Again, I've got multiples. And what's interesting, about 5-10 minutes ago when I had this up, when Anna was talking, all of these pairs were down here in the bottom sector. The pound yen was the weakest by some considerable way. In other words, what you were seeing was really what's reflected over on the 15 minute here. So they were all well below the midpoint here of 0. In other words, reflecting the fact that, first of all, giving you a heads up as to which were the strongest trends, and secondly, also giving you a view on the market sentiment. In other words, is the yen being bought or sold universally? And what we're seeing right now is we're starting to see this lift. We're starting to see, and it's almost like a radar screen, the array. It sort of sweeps around the whole time as the lines move up and down in this sweeping motion. And what we're seeing now is we're starting to see the New Zealand yen leading the pack. The Aussie yen is joining it. And if the pound yen is going to follow suit, then it's going to sweep up along with these others. But these have already come a long way because, as I say, 10-15 minutes ago, these were all down at the bottom. And they're now starting to sweep higher. We're starting to see it over on the 10 minute, and we're starting to see that progression over onto 15. And again, it's a facet of this particular indicator. Not only does it give you the strength of the trend, but it also gives you a view on the sentiment across this particular complex. And the nicest one is always the yen complex. Because the yen is always the counter currency, you get this sweeping motion of them all either coming up together or all moving in the opposite direction. Now, what it tells you, obviously, is that if you're going to trade a particular currency pair in the complex, it may well be trading opposite to what everything else is doing, which is fine, but at least you understand that. In other words, what you're looking for the whole time is, am I trading with the universal flow of sentiment? The river, if you like. You've got a torrent of water coming down. You want to be paddling with that torrent. Occasionally, you will trade against that torrent, but that trade, taking that trade, the opposition trade, to the universal flow is much higher risk because you're trading against what the general market is doing. So that's what we're looking for the whole time. Now, in addition to that, over on the right-hand side, just pull this over. This is on Trading View. I've got the VIX here. So what is the VIX telling us right now? Well, this is the daily, and we've been banging on about the daily for some time because whilst the US indices have been roaring higher, particularly the NASDAQ, which has just been going to ever higher levels, the VIX itself has not been following that trend. We've highlighted it so many times. For where the NASDAQ is, the VIX should have been down in at least down to double digits, down in the 10s, 11s, 12s, and possibly even single digits, and it was refusing to fall. It was down at this level, and it was just giving you a strong signal that we're expecting a correction, and that correction has now arrived. In terms of intraday, this is what we've got on the 1 minute. This is on the 5 minute. This is on the 10 minute, and this is on the daily. So on the 1 minute at the moment, we've got the VIX moving lower. So in terms of the VIX moving lower, what does that tell us? Just move that out of the way. What we expect to see is, let's go and have a look at the US indices, which I've got down here. There we go. What we expect to see is US indices rising, which is exactly what we've got. Strung along the top, we've got the 5 minute time horizon for the YM, the NQ, and the ES. In other words, the Dow, the NASDAQ, and the S&P 500. Down at the bottom here, I've got the dailies for the same time frame. You can see what's going on. Yes, we've had 3 strong down days. Fantastic trading on the indices, I have to say, particularly yesterday and the back end of last week. Absolutely amazing. And also on the yen complex as well. Same sort of thing yesterday. Now we've got the reaction coming in. From an intraday trading perspective, this is what we're seeing. We're seeing risk on sentiment starting to develop. You've seen it on the VIX, you've seen it on the US indices, and now that's why you're seeing it in terms of the yen pairs. And that's why you're seeing this strong yen selling, and it's yen selling in terms of risk sentiment reflected across the related markets. Now it's a question of picking your pairs, and if you were picking the pairs, as I said earlier on, the strength of buying in the Aussie, the euro's rolled, but the commodity currency is really moving strongly. So if you were trading this right now, the pound yen is not the one to be on. The pound, the ones that and they're truly delivering right now are the Aussie and the New Zealand, because they are really rising strongly, being driven by that. You're looking over at the VIX, see what's going on the VIX. You have an eye on the indices. It's not the pound. And this just really makes the point, because the pound is now falling with the yen. So there's no strong trend there. You don't expect to see a trend. You're seeing this sort of thing going on. In other words, you're seeing congestion. So in terms of a chart, I can tell you right now, if you're looking at pound dollar, you'd see a similar sort of thing. Euro pound, same thing. Pound yen, we've got. Everything else is starting to move. So in terms of looking for opportunity, it's into the commodity currencies. The CAD started to lift itself from its sick bed down here and oversold. That's now rallying. Aussie's rising strongly and New Zealand's rising strongly. Just have a quick check on oil, see what's going on in oil. That's been heavily bearish the last few days or so. Okay, and we're seeing a little bit of a tick up in oil. This is on 5, this is on 10. That is going to be helping the trade. If you're in CAD yen, for example, that would certainly be helping you give some bullish sentiment to the Canadian dollar, to help develop the trend, which is largely being driven by the Japanese yen. This is another chart, completely different market, but the principles are exactly the same. Multiple time frames, indicators working the same way. I've got time and sales running down here, so I can keep an eye on what's coming through in terms of order value, order quantity. 15-second chart of oil. What have we got? We've got volatility trigger. What do we expect to see? Congestion or reversal. If you see that snap move and you're tempted to jump in and you get the volatility trigger, just wait, be patient. If you're not in the market, it's a trap move. And the reason it's a trap move is because the whole philosophy of fast moves in the market is driven by the insiders, the market makers, big operators, because they know one thing: you have a fear of missing out. If you saw that snap move, your instant emotion is to jump in, get into the trade. Oh, I don't want to miss out. Jump in, it's fast moving, I'll make some quick bucks. No, you won't. What you'll do is you'll get trapped in one of these positions. The market is now going to move into congestion phase. Now, ultimately, it may well move through and continue in the bullish trend direction. But the fact is, you've had to suffer some emotional turmoil in here, and that's what it's all about. It's all about the emotional fear of missing out, and that's why the volatility trigger is so powerful. It gives you that signal heads up. It works in all time frames. It's on 15-second here, so it's very quick, but it'll work on every single time frame right the way out to the weeklies. So what you expect to see is you expect to see either congestion follow, which is what we're seeing right now. In other words, pain for you as a trader, because you've jumped in on the expectation of a long position. Now we've gone into congestion. You're not sure what's happening. You're a bit worried. You're nervous. And the longer this goes on in congestion, the more likely it is that you'll close out and take your trade off the table. That's the emotion, the fear of missing out, and that's why volatility is so powerful, not to you, but to the market makers, because it is the opportunity for them to trap you into a weak position, to really put the screws on your emotional trading pressure, and then to ultimately either be stopped out or you'll get out. If you can sit through it, that's fine, no problem at all. If you think the market is going to continue higher, absolutely fine. What I'm saying is it's a precursor to either congestion or reversal. Yep. Okay, I'm just going to pause there because I've been rattling on. Let me pass back to Anna.